$635 billion. That's how much Microsoft, Amazon, Alphabet, and Meta plan to spend in 2026 building the infrastructure to win the AI race. Data centers, chips, power systems, the biggest concentrated corporate spending wave in modern tech history. And by the end of this video, you'll understand exactly why that number just ran into something money alone can't fix, and what it means for the most hyped investment story on Wall Street. The third thing I'm going to show you is the twist nobody in Silicon Valley wants to talk about. But one analyst saw it coming, sitting in a conference room in Houston. So sit back. This one's going to change how you look at AI. Here's what most people get wrong about artificial intelligence. They think it's a software story. Algorithms, models, code. Weightless, frictionless, digital. But Melissa Otto, head of research at S&P Global Visible Alpha, spent years measuring the AI boom from the inside, tracking estimate revisions, building the Visible Alpha AI Monitor, which projected AI-exposed revenues growing from $410 billion at the end of 2022 to nearly $780 billion by the end of 2025. And what she found, embedded in all those numbers, was something the headline narrative kept skipping over. AI is not a software story. It's an electricity story. Walk into a hyperscale data center, and the first thing you notice isn't screens or servers. It's sound, a roar. Cooling systems moving enough air to ventilate a stadium. Turbines working. Electricity doing physical work, around the clock forever. A single large data center can draw 300 megawatts of continuous power. Enough electricity to run roughly 240,000 average American homes from one building. The IEA calculated that a single AI query uses about 10 times the electricity of a basic Google search. Scale that to hundreds of millions of queries every day, and the numbers stop feeling abstract. The IEA projects global data center power demand will nearly double by 2030, from 415 terawatt-hours to around 945, growing 15% per year, more than 4 times faster than every other sector on Earth. In the United States alone, data centers are on track to account for nearly half of all electricity demand growth through 2030. Half. The U.S. Energy Information Administration called it the strongest 4-year stretch of electricity demand growth since the year 2000. The last time America's grid grew this fast, people were still using dial-up internet. That's point 1. At its physical foundation, the AI boom is the biggest electricity demand shock this country has seen in a generation. Not a chip story, an electricity story. Now here's where it gets interesting. Knowing AI runs on power is one thing. Knowing the power system is already buckling under that demand, that's something else entirely. JLL, the real estate firm, released data in 2025 showing the average wait time for a US data center power connection had risen to 4 years. Not 4 months, 4 years. In Northern Virginia, Data Center Alley, the single most important physical location in the global AI economy, co-location vacancy had fallen below 1%. There is, in the most literal sense, no more room and no more fast electricity. PJM, the grid operator covering the Mid-Atlantic and Midwest, warned that starting in summer 2026, it would have just enough capacity to keep the grid reliable, while transmission upgrades needed to serve new demand faced multi-year delays. PJM's own market monitor filed a formal complaint, arguing that data centers should only connect if they could actually be reliably served. It noted that data center loads had already pushed capacity auction revenues up by $16.6 billion across the last 2 auctions. The grid is repricing because of AI, and it's pricing upward. Think about that. The companies building tools that generate a business plan in 30 seconds can't get power connected to their buildings for 48 months. The constraint isn't algorithmic, it's a copper wire, it's a substation, It's a transformer that takes 18 months to manufacture and ship, mostly from factories in South Korea and Germany. Power, as one industry report put it bluntly, has become the new real estate. If this is landing for you, the kind of story that makes you see a big headline completely differently, hit subscribe. I drop videos like this every week, and the best part is still coming. Alright, remember how I said there was a twist nobody in Silicon Valley wants to talk about? Here it is. In March 2026, Melissa Otto went to Sarah Week, S&P Global's flagship energy conference held in Houston. She walked into a room that didn't feel like Silicon Valley at all. Conference center carpet, PowerPoints full of supply curves and rig counts, energy veterans who think in barrels and BTUs. And she listened to Mike Wirth, the CEO of Chevron, stand up and tell that room something it did not want to hear. The oil market was not pricing in what was happening in the Middle East. Visibility was limited. Inventories would take time to rebuild, even after the conflict ended. In a room full of professional price watchers, that statement landed like a stone in still water. Otto noticed, because she was one of the few people there who had spent the previous 2 years living inside the other narrative, the $635 billion capex wave, the AI earnings story, the consensus estimates. And she understood, in that moment, exactly what Wirth's words meant for the numbers she'd been tracking. Here's the chain. Data centers run on electricity, but in most American grids, the price of electricity at the margin is set by natural gas. When Middle East conflict threatens oil supply, risk signals move through energy markets broadly, and gas prices respond. A data center that looks insulated from geopolitics because it plugs into a wall socket is actually downstream of the same supply chains as every other energy-dependent industry. And that's before you count inflation. Oil shocks raise construction costs, financing costs, and risk premiums. For a 300-megawatt campus, a $10 increase in the price per megawatt hour adds roughly $26 million a year in operating costs. Multiply that across dozens of campuses simultaneously under construction. Otto called it a major hurdle, not an alarm. Precise language from someone who looked at the full model and found a gap. And here's the twist that makes this unforgettable. The hyperscalers already knew. That's why they were scrambling. Google signed what it called the world's first corporate agreement to purchase power from multiple small modular reactors, up to 500 megawatts, first unit by 2030. Meta announced nuclear projects targeting 6.6 gigawatts, enough to power over 5 million homes. From one company's announcement, in 1 year. Microsoft restarted a nuclear plant that had been shut down since 2019. 3 Mile Island, back from the dead, resurrected to power the AI era. The most futuristic companies on Earth were calling nuclear engineers and geothermal startups and saying, "Please, we need your very old-fashioned electricity." Once you see it this way, you can't unsee it. The companies selling the future are buying the most old-fashioned energy solutions imaginable. Not because they want to, because they have no choice. AI doesn't run on optimism, it runs on power. And power is still governed by pipelines, tanker routes, and the oldest forces in global markets. So there you go. AI is an electricity story. The electricity system is already at its limits, and a Middle East energy shock just turned a $635 billion bet on the future into an open, live, unanswered question. Melissa Otto didn't say the boom was over. She said the story was incomplete. Now you know what was missing from it. If this changed how you see AI, share it with someone who still thinks it's just a software story. And subscribe, because next week we're going even deeper into the infrastructure trade nobody's watching closely enough.